Hey, welcome back dividend and value investors. If you're new to this channel, welcome. I'm European dividend growth investor. On this channel I discuss anything around dividend investing and with a strong focus on stock analysis. Having said that, I would love to share my thoughts about Texas Instruments earnings today. It's a company that I started building up a position in earlier in the year when it started to trade below $170. Hence, I'm very curious to learn whether the company delivers on its promise. Let's get started. And guys, it's trading actually after hours 2.5% up, so it's seemingly Wall Street is happy with the numbers, but we don't look at the headlines, we dive into the numbers. So if we look at Texas Instruments, the first thing that speaks out is that they have an earnings per share of $2.45. You need to know in quarter one 2022 it was $2.37, so a slight increase, which is actually really good because there's seasonality in their numbers typically. If we then look at the year ago numbers, revenue increased 14%. It's really good. Remember, we still come from a pandemic high, so this company is really top notch on this. And the free cash flow number of $5.9 billion over the last trailing 12 months. We will look into this a little bit later because that's actually the main questions. The headline says that the earnings are good, but what about the free cash flow? So also if we look at the outlook for the third quarter, it's expected between 2.23 and 2.51. I would say in general, I believe that the expected earnings per share on an annualized basis are around $9.5 to $10. And that would give the company currently a PE of around 16 to 17, which is relatively valued, I would say, for such a quick, rapid growing company. Having said that, so earnings per share 20% up year over year. I think this is important to look at, but the free cash flow actually is down 9%. And this is what is important here because the trailing 12 months last year was 6.5 billion. Now it's around 5.9 billion. You can see also the free cash flow of revenue is just 8% less. This is a big bummer. But why is this then, right? We need to quickly look into this. But before we go there, I also wanted to share with you that the total cash currently returned is 2.2 billion. If we look at the free cash flow, it's 1.1 billion. So they burned 2 times more cash than they received in free cash flow, which is really a result of the stock repurchases. So in my opinion, it's still okay, but we need to keep an eye on this. If we look at the income statement here, you can also see again, compared to last year, lots of more revenue. It triples down straight away to the net income. Nothing else really to observe here. If we go then to the balance sheet, what I would like to highlight is that the accounts receivable and the short-term investments went up. Accounts receivable is still money that they should receive from their customers, and we will see this soon also back in the free cash flow statement. Overall, total assets grew with 4 billion on an annualized basis. It also means that the debt went a little bit up because some of this was sponsored by debt, but only 1 billion. But what's really worth calling out is that most of the assets were increased by the retained earnings. So these are the profits that it made over the last year, and they go to the equity part of the balance sheet, and that is with us. And this is what we are really, really happy with, of course. And therefore, the debt to equity is still really good with a 10 to 14 billion. If we then look at the free cash flow, and here it comes, right? Net income, you can see it's approximately 3.5 billion more. But if we then start looking at some of the big things, accounts receivable, almost 400 million. So there comes already a big difference that will bring the free cash flow down. Also, inventories went up. I listened to the earnings call, and I believe it was the CFO that was telling us that, because of the China lockdown, there was some time that they couldn't really do proper business there. Hence why most of the revenues also came in the last part of the quarter. So they were able to book the revenues, but they were not receiving the money yet. So this money is expected in the next quarter. That's why, for a large part, free cash flow is down. But having said that, they have also building up inventory, and they also mentioned in the earnings call that they are building up inventory not as a one-off. So we should also expect more inventory buildup next quarter. And the reason for that is that they want to create more flexibility to serve their customers. They don't want to be supply constrained, which they had a little bit in the last few quarters. So this is a thing there to stay. Hence, we need to sit through this cash burning activity, let's say, over the next 2-3 quarters. But it is actually really good for us as investors. It's just like the pain we need to sit through this year from a free cash flow point of view. All in all, the cash flow from operating activity is therefore lower than last year. Place on top of that more and higher capital expenditures of 600 versus approximately 400 last year. This is also something there to stay. They're investing heavily to increase the supply towards their customers. They're also counting on the CHIPS Act, but the potential windfall of the approval of the CHIPS Act is not yet used in their guidance. Hence, in my opinion, this is really a conservative estimate from their board of directors. Having said that, I still wanted to call out a little snippet from another document that they released with the earnings, and this is more like about the segmentation. So the main revenue driver here was really the industrial market, which was up high single digits, and specifically the automotive market is good to mention here, but there's weakness in the personal electronics space. We've seen this also in the Microsoft numbers. There's just less computers being shipped as an example. Other devices as well. So, and I think this is because of the pandemic high that we saw and less need for, let's say, new sales now. Sales during the pandemic were simply brought forward. So knowing all of this, let's also go to my dashboard. If we look at Texas Instruments, I was assuming a 6.5 billion of free cash flow as a baseline. It's not making it at the moment. We have a 5.9 trailing number. So I'm a bit overestimating the baseline for my fair value calculation. But remember, at a 10% growth, which is doing more now, if we look at the earnings, it's like 14 to 20% growth year over year. 6% thereafter, and a discount rate of 10 and a terminal multiple of 17. I believe that the company is worth $166, which is the same as what is currently trading about after hours. If you look at it from an earnings multiple point of view, you're having it at a forward earnings of approximately 17. Current earnings are rather around 19. So depending on which valuation you take, I believe the truth lies probably somewhere in the middle, but I find the stock still attractively valued. I bought already quite a lot in this price range, so I'm waiting for another dip at this moment in time. But other than that, I'm very bullish on this company. I hope the free cash flow will recover next year again. The CFO in the call was expecting that, so let's see if we can count on their word. I have no reason not to believe them. But guys, this is it from my point of view. If you like this video, please hit the like and subscribe button. Follow me for more of these kinds of videos. See you again.